What is the current leverage level across the portfolio, and how does that affect returns?
So we have a relatively low level of leverage, particularly compared to the rest of the infrastructure renewables peer group. Our gearing is currently at around 30%, and that consists of both project level debt within project companies themselves, and also the fund level gearing. All of their debt that sits within our project companies is fully amortizing and with fixed interest rates, so we don't carry any risk there with respect to interest rate volatility. And our valuation assumes that all of that debt amortizes as well. So we take a very conservative view on gearing, and combined with one of the highest weighted average discount rates across the portfolio, we think that puts us in a very strong position, particularly compared to the rest of the peer group.
Have you had any exits from the portfolio yet? And what have they taught you about valuation and market appetite?
Yes, so last year we sold about 10% of our portfolio via two transactions. That was a sale in part of our AD portfolio to a company called Future Biogas, which is also the operator of those AD facilities. Now that was a very good sale for us that recognised a premium to our holding value, and also it meant that the alignment between FGen and Future Biogas as the operator is now stronger than it has ever been, given that we are now co-shareholders together. And we are working with Future Biogas on a series of value enhancements across that portfolio, which is very exciting for us. The other transaction was the sale of our solar rooftop portfolio, also at a premium to the holding valuation. And that transaction, the objective there was to recycle capital from a non-core, lower returning part of our portfolio to put that capital to better use elsewhere. What we learned from those transactions is that, firstly, because we're able to recognise premiums to holding value, it gave us a lot of confidence in our valuations. It also taught us, I think, that it is probably a more challenging market to sell into compared to previous years. The other thing we learned from those exit processes was that compared to previous years, it is arguably a more challenging market to sell into, and that really derives from the interest rate volatility we have seen over the last few years. And so what that means is that any sales process has to be very well planned, it has to be well managed, and you really have to think about the buyers that you are targeting. But fortunately, we were able to do that, and as I say, both of our transactions realised premiums to holding value, so it was a very good outcome for us.